So you're ready to invest, you've seen the headlines, and you're feeling that little bit of pressure, that fear of missing out. Well, hit the brakes for a second, because jumping into the market without a clear plan is the single fastest way to lose your money. The biggest mistake a beginner can make is not knowing if they're actually investing or if they're just gambling. This video is your essential first step, as I've spent years navigating these markets, and I'm going to give you the blueprint. We're going to compare the two most popular methods, trading and investing, so you can avoid the number one trap that wipes out new players and start your financial journey the right way. Anyone who puts money into the financial markets, whether they know it or not, is standing at a fork in the road. On one side, you have the path of the trader, and on the other, the path of the investor. Now, they might both lead to a place called profit, but the journey, the mindset, and the skills needed are completely different. Confusing these two is like trying to use a map of New York to navigate the streets of London. So, your very first decision, before you even think about opening an account or picking a stock, is to choose which path you're going to walk. That choice will drive every other decision you make from here on out. Let's break down what each path is really about. Let's start with trading, because it's flashy, it gets all the attention, and frankly, it's what a lot of people mistakenly picture when they hear the word investing. Trading is all about the short term. It's an active approach focused on cashing in on market swings. The best way to think of a trader is like a pro surfer, obsessed with the here and now, the shape of the next wave, the direction of the wind, and their exact timing to ride that wave for a short, thrilling burst of profit. Traders use a discipline called technical analysis, which is basically the art of studying chart patterns and market stats to guess where prices will go next. The most intense style is day trading, where a day trader buys and sells within the same day, making sure all their positions are closed before the market shuts down. This isn't a hobby, it's a full-time job where you are glued to your screen, making dozens of trades, and the mental stress is unreal. For this reason, I tell almost every beginner to stay far, far away from it. A slightly more approachable style is swing trading, where a swing trader holds positions for a few days up to a few weeks, trying to capture a single swing in the market. The reality of trading is that it's a high-performance skill, with a brutal learning curve and a famously high failure rate. You're not just competing with other amateurs, you're up against billion-dollar hedge funds, PhDs in physics, and AI algorithms that can trade faster than you can blink. Now let's talk about that other path, investing. If trading is like surfing, investing is like planting a forest. You're not trying to ride one perfect wave, you are carefully selecting good seeds, which are just great businesses, planting them in good soil and giving them the one thing they need most, time. You let them grow through the seasons, the sunny springs and the harsh winters, and over years and decades, they grow into a massive, valuable forest that takes care of you. Investing is a long-term game. It's about owning a piece of a real business and sharing in its growth and profits over time. You're focused on the real value. Is this a good company? Does it have a solid moat? Is it likely to be bigger and more profitable 10 or 20 years from now? The biggest reason to adopt this mindset is to fight a silent killer of your wealth, inflation. If your money is just sitting in cash, it's guaranteed to lose its buying power every single year. Investing is the most proven way for a regular person to outpace inflation and actually grow their wealth over the long haul. An investor's job isn't to predict the unpredictable, it's to have a little faith in the long-term growth of the economy. Instead of staring at charts all day, an investor spends their time figuring out their goals, setting up a dead simple plan, and then automating it. The strategy is time in the market, not timing the market. All right, you have the hyperactive short-term trader and the patient long-term investor. The choice between them really comes down to one question. What is your goal and what kind of life do you actually want? It boils down to this. The trader is focused on price. The investor is focused on value. Let me be brutally honest with you. Trying to become a successful trader is like trying to become a professional athlete. Is it possible? Yes. Do a few people get incredibly rich? Absolutely. But the vast majority of people who try will fail and many will lose a ton of money. For the overwhelming majority of people, I'm talking 99% of you watching this, the more reliable, more proven, and way less stressful path to building wealth is investing. It's a system designed to work with your main career, using the magic of time and compound growth. Now, if your heart is absolutely set on learning to trade, the research suggests that swing trading is a more manageable place to start. But please treat it like you're earning a university degree. Start with a practice account and don't you dare touch real money until you know what you're doing. But if your goal is simply to build a nest egg, fund your retirement, and create financial freedom, you're an investor. If you've decided the investing path is for you, then congratulations, you've just made the single most important decision of your financial life. Forget the hype, forget the noise. Here is your simple 3-step plan to get started the smart way. Step 1, the mindset shift. It's all about changing your time horizon. Stop thinking in days or weeks and start thinking in decades. The stock market will go up and it will go down. There will be scary headlines, recessions, and full-blown market crashes. Your job as a long-term investor is to simply ignore the noise and stick to the plan. The biggest trap is panic selling when the market is down. By committing to the long term, you prepare yourself to see downturns not as a crisis, but as what they are, a sale. Step 2, the easiest way to start. Next, you need to embrace diversification. Don't try to find that one magic stock that's going to the moon. Why search for the needle in the haystack when you can just buy the whole haystack? For a beginner, the easiest way to do this is with a broad market index fund, usually an ETF. An S&P 500 index fund, for instance, lets you buy a tiny piece of the 500 biggest, most successful companies in the US with a single click. It is instant diversification. You're no longer betting on one company, you're betting on the long-term growth of the entire American economy. Step 3, make it automatic. The final step is to take your own worst enemy out of the equation, your emotions. The best way to do this is with automation, using a strategy called dollar cost averaging. It just means you invest a fixed amount of money on a regular schedule, say $100 every 2 weeks, no matter what the market is doing. When prices are high, your $100 buys fewer shares. When prices are low, that same $100 buys more shares. Over time, this smooths out your average cost, and more importantly, it turns investing into a boring automatic habit, just like paying your phone bill. You build wealth in the background without the stress and second guessing. So that's it. Your first most critical decision isn't about which stock to buy, it's deciding who you want to be, a trader or an investor. Strategy comes before tactics, always. Understanding this difference is what separates disciplined wealth builders from gamblers just hoping to get lucky. You now have the blueprint to avoid the biggest mistake most beginners make. Every successful investor on this planet started exactly where you are right now, with a choice. Please remember to like this video and subscribe to our channel for more content like this. It's important to note that this video is for educational purposes only and does not constitute financial advice. For more valuable insights, why not visit our bookshop packed with a wealth of financial educational books and smash the link in the bio.